All righty, welcome everyone to today's Sunday macro wrap up. This is for Sunday, June 15th, Father's Day in the United States. So, any fathers who are joining in here, happy Father's Day. So, getting into this right here, we have a pretty interesting week coming up. We have a Fed meeting on Wednesday, as well as retail sales on Tuesday. Not too crazy besides those two things in terms of macro announcements there. But what's interesting is that, the conflict in the Middle East, the escalation there is causing a lot of people to, become fearful in the markets. And although there is, more risk, right? Similar to how, if you guys remember back in 2022, when there was when Russia invaded Ukraine to kick off the Ukraine war, that did cause a little bit of a downtrend, and we also had a spike in oil. So we really haven't seen that magnitude until now. We'll see though. Time will tell if this will be an actual reversal point within the equity markets, but you still have it in bullish trend, right? So if you guys can see the bookshelf in the background there, it still remains green. So that means that the S&P 500 remains in bullish trend despite the end of the week last week in the equity markets. And so we'll see how that unfolds here at the beginning of the week. But just taking a look at some of the things that we saw last week, consumer sentiment had an interesting rebound, as well as we had a little bit of a pop in inflation, right? So CPI came in at 2.4% year over year from 2.3%. That wasn't a 1 month acceleration, but it wasn't as much of an acceleration as the market was expecting. And so it did take that as a positive point and saying that or expecting that, inflation could be coming down. But that's not what the bond market as well as what the futures market is saying. That might be what the equity markets are saying, but not all markets are the same. And so, in taking a look at the CME Fed Watch tool, the first cut by 25 basis points is being priced in for the September 17th meeting, and there are no cuts being priced in for the meeting this week. Right now, there's nearly a 97% chance that they remain paused. And then looking at July 30th, which is the next FOMC after this week's, that's at a 78% chance that they remain paused, right? So, and this is all happening as the price of oil is just dramatically accelerating, right? So, for those in our macro investing communities, you saw that the trend of oil went bullish last or on Monday of last week, and there was one tiny little buying opportunity on Tuesday before it absolutely just went crazy due to the conflict escalation in the Middle East. But what's interesting is that our model did flag it as going bullish trend before it had this large acceleration. And so, I think that the signal did its job well there, despite, the headlines that we saw. And from what we've noticed with our signal is that it typically front runs a lot of the headlines that come out, only because although insider trading is still illegal, it doesn't mean that it doesn't happen, right? Just because something is illegal doesn't mean that it no longer happens. And so that the same thing is true with insider trading. And so when you have things start to shift in trend in a weird way, just like we saw in oil, it was almost like it was front running something. And then, a couple of days later, you had the escalation rise in the Middle East there. And so the why doesn't really matter. Just looking at the math is what matters. And so this acceleration is happening, as we've noted beforehand, as the rate of change of oil was this time last year decelerating, right? So the comparison or the comp is an easy comp. And that all means that with oil accelerating on easier comparisons, that essentially is going to be a headwind towards the decelerating inflation or the disinflation progress, right? So a lot of people who are, looking for inflation to dramatically, continue lower down to the Fed's 2% goal in hopes of them preemptively cutting rates, that is being threatened right now by what oil is doing. And so, even if the price of oil was just staying steady, that still would have been a slight headwind as the rate of change was still going to go higher as the comparisons got easier. And so what do I mean by this? If we look at the indicator called the rate of change, you can go ahead and click on that. This is a built-in indicator within TradingView here. And as you can see, look what oil just did on a rate of change basis, right? Well, let me see. This is on, let me make sure this is on 252. I'm going to put that on 252 for 252 trading days in a year. And so, this has been accelerating. Well, as we saw this time last year in 2024, the rate of change of oil was decelerating, right? And so that acceleration versus deceleration is obviously a headwind towards the inflation progress. And so that's what I mean looking at it visually. All right. So not to say that the, inflation components are all energy related, even though, the price of oil, energy as a major input in the entire world economy, especially in the United States. Higher oil prices could lead to higher prices in other things, not just oil. So oil is a leading indicator, and it's also one of the larger components of CPI, one of which that has been one of the main reasons why CPI has been coming down is because oil has been in a deflationary pattern, meaning the inflation rate is negative, right? So you have to remember there's three stages of inflation. There's inflation, which is the rate of inflation is accelerating. Then you have disinflation, which is when the rate of inflation is still positive, right? So it's above zero, but it's just getting less positive, right? So going from a 9% inflation rate down to a 2% inflation rate means that you had 7% of disinflation. But let's say you went from 3% inflation down to negative 3%. Well, then that would mean that you are in deflation, meaning that you are now at a negative year-over-year rate of change for the rate of inflation, right? So, you have inflation, disinflation, and deflation. Typically, deflation is what happens when you're in a full-blown recession. And I don't think we've had deflation in quite some time. I think the last time was during the 2020, COVID pandemic shutdown, and then the previous one was during the 2008 Great Financial Crisis. So deflationary periods are extremely rare and typically a sign that the market is bottoming. But we're not seeing that here, obviously, with the price of oil. And so this is what the Fed is paying attention to. This is what the futures market is paying attention to, and also what the bond market is paying attention to, right? So if we take a look at the bond market here, if we pull up a chart of the yield curve, which is the 10-year U.S. government bond yield minus the 10-year U.S. government bond yield. Let me make this into a line graph just so it's a little bit easier to look at. This has stopped going up, meaning that it's no longer steepening and it's been flattening. And so let me see if I can bring up a chart of that here. Okay, yeah, here we go. Let me just zoom in here. So this is our team's yield curve phase signal. And so ever since April 22nd, the yield curve has been bear flattening, meaning that 2-year rates have been rising faster than the 10-year rates, right? And so for those unfamiliar with how to read the yield curve, typically on the short end of the curve, that is more so of a proxy of Fed policy of interest rates. And so we look at the 2-year for that. And then the 10-year is the proxy of the bond market's expectation of future growth and inflation. And so that has actually gone down by negative 1.18%. So you have growth or inflation, coming down, as well as rates rising. So that causes what's called a bear flattening. There's 4 other phases, and then within that, there's 12 phase transitions, all of which we teach in our macro investing community so that we can be prepared for these big shifts that the bond market is pricing in. And for those who are unfamiliar, the bond market is much larger than the stock market, and it's also more of a just like how the stock market prices in future expectations, so does the bond market. And the bond market typically does a better job because it's less manipulated. Anyways, that's why we pay attention to this. And so seeing that it's bear flattening, it's essentially saying what we've been talking about, which is that the Fed is remaining pretty tight, right, with their monetary policy. There's no cuts being priced in currently. And at this pace, I would not be surprised if we don't have any rate cuts in 2025, right? I think at this point, what's really going to get it to be priced in is if you see either a large drop off in growth, which we've already seen a decent drop off, but we've seen a little bit of a slight rebound / just going sideways, or you get a large deceleration in both growth and inflation. That's what would probably get this back into a steepener mode, which is really when you see things like Bitcoin and the stock market do better, which is in those types of conditions. So we'll see what happens from here, but this is all indicative of a stagflationary environment, right? So that's not necessarily a bad thing, but because there's definitely assets that you can be invested in, but that's what it's currently signaling here. And so, gold remains in bullish trend. Let me go back to the candles here. Gold remains in bullish trend. Silver, as well as platinum, right, along with oil. So a lot of these different either hard metals as well as commodities are starting to accelerate in price. That's not very good for the inflation expectations there. And then, of course, taking a look at the S&P 500, you are having it come down to this support level around 59.76. Looking at the SPY, the ETF for the S&P 500, that is around 597. And so this does remain in bullish trend, but if we continue to get more of a scare with the conflict that's happening in the Middle East, maybe that gets the dollar off of where it's at right now, because the dollar has been selling off a lot. And then if that also accelerates the price of oil even further, then you could see a much larger correction in the S&P 500. But in any sense, it still remains in bullish trend. So there's not really a point in trying to call for like a bear market right now, because that's definitely not the case. All right. And so that's pretty much what I am seeing for the week coming up here. Yeah, pretty much. We have core retail sales and then the FOMC press conference on Wednesday. I will be streaming the press conference starting at 2:30 p.m. So normally we'll do our live stream starting at 3:45, but on Wednesday we'll do it at 2:30. And then I will be out of town on Thursday and Friday, but I will be back for next week's Sunday Macro Wrap-Up right here on the channel. So, with that, we'll go ahead and let you guys get back to your family celebrations with the dads. The way that these Sunday Macro Wrap-Ups work is that typically the first half is streamed online, and then the second half is only reserved for our Macro Optics members. So for those on the Zoom call, if you want to stick around, we'll just be going over a couple of the ideas that we are seeing. For those who are joining us, if you'd like to gain free access for an entire week, you can go to the link in the description below for those on YouTube. For those on Instagram or TikTok, you can go to the link in the bio there. But appreciate everyone for joining. Have a great rest of your Sunday, and we'll catch you next week.